So you have these concerns about the economy because of trade tensions, and the issues have created some wild days on Wall Street this month. Is there a way to protect your portfolio from all of the volatility? Joining us tonight, Jimmy Lee. He's CEO of the Wealth Consulting Group. Welcome back. Good to see you again.
Thanks, Bill.
You know, clearly owning Treasury bonds would have been a good hedge over this past month. The stocks went down. They've been going up, pushing rates down. But is it too late to protect your portfolio in that way, do you think?
Well, I don't think it's ever a good idea for the average investor to try to market time, Bill. That's never really worked. I think what's most important for the viewers is just to be calm and not panic. And actually, for long-term investors, this is probably a great buying opportunity because, as you said, most of this concern is about the trade issue. And yes, it is causing some other economic potential data to look like the economy might be slowing. But when the trade deal is done, I think we have a chance that the stock market could even set new highs.
You make the point, Jimmy, also that you can harness this volatility if you do what's called dollar cost averaging. So you're actually having the volatility of this market work with you if you're consistent.
Yeah, Sue, typically there's two types of investors. So if you're in wealth accumulation mode and saving for your retirement, then regular systematic investing like people do in their 401ks that we call dollar cost averaging, volatility is your best friend. Think about it as a discount or sale on things that you want to buy at lower prices. So dollar cost averaging works really well. So if you're in wealth accumulation mode, that's really good. But if you're a retiree, make sure you have 1 to 2 years of your living expenses in cash or cash equivalent type investments that do not go down in markets like this, so that you don't have to worry about selling your stocks at a discount to make your living expenses each month.
This has been a pretty defensive market, though, lately. Areas that traditionally do well when rates are going down or when the economy slows down, utilities, healthcare, areas like that, consumer staples, they've been doing well lately. Do you like those groups?
I do. Our firm has been taking our profits from the growth sectors, even though that we're still a little overweight tech. I think you have to take a look at your portfolio, and in times like today, it's very important to have a globally diversified portfolio. And if you're overweighted in a lot of the growth sectors that have been leading the market for the last couple of years, including this year, it's a great time to make sure that you're evenly balanced. And so look at value stocks. Value stocks might hold up much better in the correction if you're worried about that as well.
What about technology? Do you feel that we're nearer to a bottom in technology? Some of those stocks have really been hit quite hard. Would you step in at this point?
I think if they're good names, I would be very wary of the high multiples still, Sue. But I think technology still has more room to run. And I think that even if we get a further decline, let's say that we'd end up in an official correction of 10% or more, we've been there before. You remember, investors, if you started the year at January 1st, we're still up double digits even after this move down. I think most people would be very happy that if their portfolios are up over 10% in stocks through the first 5 months, and that's where we're at. So let's take everything into perspective. So I think technology is actually still a good sector to have.
All right, very good. Jimmy Lee with the Wealth Consulting Group. Again, thanks for joining us tonight.
Thank you.